Welcome back to another episode of In Focus with Haversine Funding, the podcast where we discuss trends, insights, and strategies to grow your financial platform. I'm your host, Nolan Reichert. Today, I'm joined by a special co-host. Once again, we got Vince Mancuso, our co-host.
Thank you, Nolan.
Thanks for joining us.
Absolutely.
Uh, and we have a special guest today, Mark Seigel, the co-founder of Crown Partners. He's been in the ABL space for 20 plus years, started out as a lender and is now an advisor. Mark, thank you so much for joining us.
Nolan, it's a real pleasure to be here. Great to see you, Vince, and thanks for having me on.
Absolutely, Mark. For our viewers and listeners, can you kind of walk them through sort of your journey, how you got into the industry and what you're doing now at Crown Partners?
Sure. I'm going to give you the brief version. I'm happy to do the 8-hour sob story of that at a later time. I've probably done that with Vince over cocktails before. But I got into the ABL industry largely by accident in my late 20s. In my late 20s, which was right after the Great Recession. That turned out to be a very interesting time. I was working for a private equity firm that was an investor in specialty finance platforms, and there was a lot of upheaval at that time. That led to my being part of a team that launched a direct ABL FinCo called Veritas Financial Partners in 2011. And in 2019, as part of the consolidation in this industry that we may discuss today, Veritas was acquired by White Oak Commercial Finance. And at that time, I launched Crown Partners as a ABL-focused advisor focused on assisting middle market companies accessing the ABL market. So spent the last, really, I guess, about 16 years focused in and around ABL. And, part of the fun of being an advisor in the space is working with a lot of my former friendly competitors and friends who, I've obviously worked with over the years.
Yeah. So, going from being a direct lender to now an advisor, what made you switch that button to go from, make that transition essentially?
Great question. So I started my career as an investment banker, so I was used to that model and understood the role in arranging transactions. When I was leading the sale of Veritas, I gave a lot of thought to what I wanted to do with the next stage of my career. And I knew I had all of this expertise and enjoyment around the art of the deal in ABL and the structuring and knowing all the different lenders. At the time, and this was late 2019 when I was thinking about what I was going to be doing, my partner and I were thinking, hey, we love the ABL transactions. We love all that goes into creating solutions. We don't really necessarily love the grind of building a big business and having all of the responsibility of risk management and capital raising, et cetera. What if we, instead of being a lender, be a solutions provider, and our value proposition to clients will be, hey, we really know this market. We know all the players. We can help you arrange a transaction with the right player. And then our value proposition to our formerly friendly competitors could be, hey, we know how you underwrite. We used to share deals. And when you'll know that if we're bringing you an idea, we've hopefully thought it through really well and are positioning it in a way that makes sense for you and allows you to efficiently determine if you're a good fit.
Mm-hmm. Yeah, that's interesting. You'd mentioned you didn't love the side of having to raise capital and then deploy to go raise more. I'm shocked that you weren't interested in that aspect of it. But so can you walk me through, you mentioned the solutions that you provide. Can you kind of walk me through what solutions you guys do provide and what that looks like when you are looking at a prospect and bringing them on and helping them through your services?
Sure. So first of all, the typical decision maker for us who we're ultimately selling to, it actually changes between companies. Sometimes it's the CEO of a business and they're given wide berth to make decisions like that. Sometimes it's a private equity sponsor that gets involved in capital structure decisions. So the first area that we're marketing is there a clear need for ABL expertise for this company? Are they trying to accomplish something that where they would be benefited from having professionals who do this all day and live in this market? And if the answer to that question is yes, then are they prepared to do they understand that, and do they want to hire Crown, which of course comes with it cost into the transaction, and where they see value to hire us to shepherd their process as opposed to trying to do it themselves, or to hire another generalist investment bank. Right. If the answer to that is all a yes, then our process is we understand how to underwrite an ABL structure. There's approximately 140 ABL platforms that comprise over 96% of the market in terms of funded volume. Crown's where we live is we need to be laser focused and cover all 140 of them, so we know exactly who has what box. And then from there, we have to determine, is there a meeting of the expectations of the client and the market? Often that's not the case, and we have to get really good at figuring that out up front, because if we have a client with unrealistic expectations, that does us no good. We take transactions to market that we believe are going to close and that do close. And so if all that aligns and their expectations are realistic and achievable, then the value we bring is really understanding how to package this transaction in a way that will ultimately be successful, not just in the screening, but then in the underwriting, structuring, and closing. And as you two know, there's a lot that goes into the sausage making, as I call it. And part of the nuance of how we market to sponsors and to companies is, we don't want to fearmonger and tell them, hey, this is a really hard process. There's a lot that goes wrong in these things. But at the same time, we try to explain that, look, like there's a lot more to closing these deals than just getting term sheets. And there's a lot of value to being proactive in thinking ahead towards the end goal and using time wisely up front so that one doesn't lose momentum during the underwriting and closing process.
And so you take on role more of a trusted advisor of sorts. Oftentimes, you had mentioned that sometimes it starts with the CEO. Other times you might be going through presumably a CFO. Is it important to you to get to the ultimate decision maker quickly, or are you on a fact-finding mission initially to determine if that's the next step?
So, Vince, I'm sure you can relate to this as a master relationship builder and salesperson, which is that the art of getting to the decision maker, you really need to get a mandate. You need to get to the decision makers, but you also need no one in the room suggesting that they not hire you, right? So, and often the ultimate decision makers make that decision without us in the room. We get to present, but we're not there when the decision is made. So it's very important that we understand who is making the decision, but that we're initially speaking with either someone at the sponsor that is not the ultimate decision maker, or we're talking to the CEO or CFO of the company. And the art for us is to get their buy-in and explain our value proposition, and also explain why we are helpful to them personally, so that they ultimately are introducing us to the decision makers, not just as an idea, but as a recommendation. And that's our process. And naturally, you don't always get buy-in up front, but that's the goal going in.
So as some of our viewers and listeners may not know, but one of the first ways I was introduced to you, Mark, was through your reports that Crown Partners puts out, sort of showing the recent transactions that Crown as well as other ABL groups have been involved in. You charted out really nice on a X and Y axis, and it gives you kind of a snapshot on like, okay, well, what's happening in the industry these past 3 months. You recently released one at the end of last quarter. Can you kind of walk us through sort of how those have been valuable? What kind of gave you the inspiration to do that? And then what are also some takeaways that you had from your most recent report?
Absolutely. The thought process on that. So Crown puts out the what we believe is the only holistically complete index of all closings in the 20 to $200 million ABL market. That's a market that has announced transactions between 1.5 and 3 billion a month. And the logic on putting that out was twofold. One, prior to having it ourselves internally, we were always curious, hey, what's the size of the market? Who's doing what? And I wish we had this. So then we went out and created it for ourselves. Then when we were thinking entrepreneurially about how do we market Crown's ABL expertise, we had ideas. I should write some articles, which are great ideas, but given that we are a small firm and running in a lot of directions, I had the idea, well, we started creating this for ourselves. We find it very useful. What if we just share this publicly, and then we don't have to create any new content? We can just use what already exists. So that's what we did. And I'm glad people find it useful, because it's something that requires no incremental work for us other than, my posting it publicly, and gratified that people find it useful, because we certainly do.
Yeah. No, I love it. It's a great resource. It's cool just to get a quick snapshot of what's happening. If sometimes your head is just in the sand in your day to day, so it's a nice breath of fresh air to kind of be able to take a step back and see it from a macro level.
Yeah, it's a powerful tool.
You referenced before we started doing the deal tables. You referenced our initial work, which was creating just a market coverage universe of all the players on an X and Y axis, and that was similarly something that we were preparing for client pitches. And then we said, well, hey, we already have this. The clients find it really useful, or prospects, so why don't we share this also? And that was the first thing that we published that went viral. And we got a lot of angry emails back from people who felt that they had been kind of short shifted on where they should be presented. And so that a light bulb went off. Oh, we've struck a nerve. We have people actually taking the time to send us feedback. In the case of some banks, some nasty grams, and that a light bulb went off. Oh wow, people actually care about this ABL stuff. So that was a motivator for us to start putting out more content.
Mark, you mentioned 140 and some odd lenders that you aggregate and you're intimate with. What's the mix with private credit versus what I'll call institutional or bank? Is it 50-50, or is it weighted heavily in one way or the other?
So by number, let's go with there's 3 buckets that we discuss internally and with prospects: bank ABL, FinCo ABL, and private credit ABL. And the differentiation between FinCo and private credit is FinCo are regular way finance companies that are themselves funded by traditional money center and other banks with a traditional warehouse structure, and are funding transactions that are more, generally speaking, more expensive than banks because they themselves have a higher cost of funds, but are classically structured in the ABL style. And then private credit, which is often unlevered or lower leverage than FinCos, are sometimes blending that gray area of ABL where they may be taking either lending on assets that are not as conventionally conducive to a liquidation, or just stretching on their overall structure. So early, when I was describing aligning client expectations with market reality, there's usually the most common scenario where there's a mismatch is for a client that is currently with a bank ABL, is having some challenge and thinks they're going to remain in bank ABL. And we don't think that that's a likely scenario. So that would be the most common element of where there's a mismatch. And, in terms of the weighting of those 3 buckets, where Crown is playing we are playing, I would say, split evenly among those buckets. And that's a function of the fact that we're probably most valuable where there's some dynamic aspect to the situation. If a company is with a money center bank and all their needs are being met, but they, for whatever reason, just want a different money center bank for whatever reason, they're probably not hiring Crown, nor are we probably adding enough value to be relevant to that. Whereas if a company has a challenge or an opportunity where additional liquidity is valuable to them, that is the major driver for where we generate value.
And I would think that if your prospect is coming out of a money center structure, maybe lender fatigue, maybe suppressed availability, or some reason they need to engage with you, my impression is it could go the other way just as easily. They are anti-bank at that very moment, and it's a breath of fresh air for you to come to them with 3 or 4 opportunities that don't look and feel like what they were just complaining about ultimately. They might have a stigma of not being with a bank, but
Yeah.
hopefully there had been some pain there on their side as well that said, gosh, this reporting is brutal, the suppressed availability is killing me, that by you opening up some of these other channels, they look to see that there can be a very, very lucrative pathway to growth and continued progression, and it doesn't have to be the money center you referenced.
Vince, absolutely. You're hitting on, I mean, we could do a whole podcast episode on the convergence between FinCo ABL and Bank ABL. And, you know, when I started in business with Veritas, there was a pretty wide gulf between Bank ABL and non-Bank ABL. It was rare that you would have a client where it's unclear which is the right bucket. And as a confluence of you know, extreme development in the asset management business and interest in asset-based financing, the reality today is there are, for the right company, there are non-bank structures that are not massively more expensive. And I don't know if we're supposed to talk numbers. I'm typically not on an industry podcast, maybe not in this one, but I'll say that the spread between the two is not so significant that it would be a disqualifier for a company to select to go with a FinCo option. And we've seen examples of sponsor fatigue with banks and just wanting a FinCo execution. And obviously that comes with higher pricing. And to the extent that the pros outweigh the cons, we've had those transactions.
Yeah, I think that kind of ties into we're in private credit in general. We're seeing a large influx of cash this way, be investors or family offices or sponsors, you name it. There's a lot of different pools that you can kind of draw money from, and so in return, another thing that we're seeing is just a lot of different ABL groups pop up, a lot of different lenders. Mark, you've been in the space for 20 plus years, and specifically with Crown, have you seen a shift, a difference in a rise of, let's call the FinCo ABL, or what has there been any activity that you've kind of noticed that that's interesting?
Absolutely. So I guess about 13 years ago, there was a crop of FinCos that formed the basis of the $5 to $25 million ABL space. And if you look at where that crop is today, they are, generally speaking, all owned by large institutional asset managers and have moved significantly up market. And those teams form the basis for what today are, on the low end, $15 million opportunities up to $150 million opportunities that they're balance sheeting. And if you look at by volume, the players that are today in the 10 to call it $25 million space, many of those firms were launched after 2018. And so it's a highly dynamic space, and that's part of what makes it fun. And at the same time, I'm now old enough where I can see history rhyming a bit with this new crop of firms that have launched and are grabbing market share.
And kind of piggybacking off that, do you anticipate to see sort of the crop 2018 circa crop continue to go up market, or do you think they're kind of where they're at? I know this is sort of predicting the future, but if you had to tap into your crystal ball, what would you see happening there?
Well, I would say that's a great question. So in a maturing market, which ABL is a pretty mature product, there's two paths to take as a platform. There's either if it's a generalist, more commodity product, you have to run at scale. And with scale comes the need to be bigger and reach economies where your platform costs as a percentage of AUM are low enough that with a cost of funds advantage, you can have an attractive return. So if a platform is owned by a large asset manager that's looking to deploy capital, I think it's likely that they will come around to the reality of the model and move up market. The other strategy for success as an ABL FinCo is what I kind of refer to as the speedboat. You can stay lean, stay small, do high margin deals, have the luxury of selectivity, maybe have a niche that you focus on and don't worry about scale, and can do really well. I think it makes sense to pick one of those two lanes and not be confused about which lane you're on. So, and if I had to guess, I'd sort of look at who the owner is and predict what their incentives are.
Right.
Any industries that you are seeing an uptick in needing your services, consumer facing, dependent upon housing starts, things like that? Are there, maybe another way to ask that is, are the money center type ABLs shutting the door on particular industries that creates opportunity for you to prospect?
So from an industry concentration, the one data point I would share is we have seen over the last 12 months an uptick in food and beverage manufacturing transactions. Maybe that's just because we're small and we did one in the space and others called us and our announcements are public. But what the common thread in those transactions were a noticeable reduction in NOLVs on inventory in the space. And, you know, the theme of what was happening is that companies were with banks and they lost a significant amount of availability under their borrowing base structure based on an updated appraisal. And those transactions tend to be inventory heavy. And there tends to be a lot of kind of in food manufacturing, a longer period of time where products stay in raw and then whip before finished goods. So there's been challenges with those appraisals. And that has created challenge. It probably won't surprise you, Vince, to learn that often our client feels that their inventory is worth more than their ABL lender thinks it's worth. So a lot of our role is kind of managing them through the 5 stages of grief as to how their inventory is going to be viewed by the ABL market. And then 2, having to find a lender that's going to lean into some other area of suppressed availability, because the reality is in both the FinCo and bank market, they're looking at the same advance rates on the same eligibles on inventory. So the only place to go is, one, if there's some fixed assets that weren't leveraged, or if, you know, we've had some success around the edges on maybe some classically ineligible inventory, like in transits or, you know, on the water, or, you know, maybe some small balance locations that a FinCo is willing to lean into to create more availability. Other industries, auto has been, you know, more active over the last year, and that's, you know, it's really a function of where there's asset heavy businesses that, you know, that have had challenges with inventory creep. Crown doesn't do as much in oil and gas, so I can't comment on that sector, although I know that there's a lot of activity for those specialist firms that have that expertise. And you know, retail is about a quarter of the ABL market nationally. And there's obviously been a lot of activity in retail, but the most common discussions there, because those transactions usually have a very large bank ABL, given how well the inventory appraises. And the conversations there are about strategies to create more availability, usually leaving the bank in place. And that forms the conversations of either a FILO, last out, or other term financing to provide to bolster liquidity with a second behind the existing ABL.
Yeah, that's really helpful and interesting. Kind of switching gears here now to, you know, Crown. Can you walk me through like a real life story where you were able to work with a client, whether it's a challenge that you guys had to overcome, or just one that kind of sticks with you for our viewers and listeners of how you've been able to help them and place them.
Sure. Well, the stories that come to mind are usually the ones where there was a real fire drill and a need for speed, and those are the ones that were the most traumatic to live through, but felt the best. So I'll just off the top of my head pick a transaction that was a sponsor-backed transaction that was financed by a money center bank, and the company had a very case-specific one-time event that caused them to become over-advanced and out of compliance. And the company had a term lender, a cash flow term lender, that because that term lender was a private credit fund, they were more able to understand the one-off nature of this event and be willing to remain supportive. But the bank, their hands were really tied structurally as a bank to what they could and couldn't do. And this company had a need to build seasonally heading into the fall, and we got retained in July or so. And so there was a real need for a solution, and time was of the essence because the business model, the bank was willing to forbear, but the based on certain circumstances, they were going to need more than the line cap within several months in order to fund their business. And it would be unrealistic to ask any bank to increase its exposure during a forbearance period. So time was of the essence, and we ultimately ran a process where we brought that transaction to market in several weeks. We ordered the field exam and appraisals before we had even done the work, so we were really building the plane as it was flying, and that was important because there wasn't enough time to run it sequentially. And that introduces more execution risk because usually you want to really fully understand the structure before you order those. And we ultimately brought it to market, and the client selected its lender based on speed and certainty, not necessarily price. And we built into into the term sheet with the ultimate lender that we selected some very extreme milestones that they had to meet because this client was so worried that the lender would not be able to meet its aggressive obligations. So for instance, date that they would take it to their investment committee, date that they would produce a first draft credit agreement, et cetera. And it was a real scramble. They lived up to their end of the transaction. It was not without the normal surprises and hiccups that come up during documentation and challenges with various third-party items like landlord waivers and access agreements. But we ultimately closed it on time. This company was able to execute on its build. This was a scenario where there was a risk of not being able to fund payroll that was avoided. And it was a great outcome. And it was a great outcome for the lender because they ultimately got probably a little better pricing and maybe some sweeteners on structure and documentation that they wouldn't have had if this company had, several more months and we could have run a process where we didn't wait as much speed and execution. So it was a win all around.
Well, I've enjoyed an outstanding professional relationship with you and a personal friendship with you. And some of my fondest memories in kind of nurturing that relationship was our ability to, talk, share ideas freely, and your transparency. And we had some really nice dialogue that helped in some decision-making processes on deals specifically that I was going through at the time. But it seems to me that you've taken that philosophy of being unselfish with knowledge, being an advisor, almost paying it forward and that's conveyed into a pretty successful business platform. So I wanted to tip my hat to you on that.
Appreciate your saying that, Vince. I really enjoy talking shop, and some of my great memories in the industry include events or conferences, or even just us two going out to dinner and other friends in the industry going out to dinner and just talking shop and talking deals and talking about where the market's going. So it's something that I personally enjoy, but also in terms of building Crown's market presence, it's not really my style to go put my sales hat on and say, hey, go hire Crown, we're great. It's not, it feels much more natural to me to just put out information about our market and say, hey, here's what's going on in our space. And hopefully some segment of people say, hey, these guys produce good content and have good ideas. And if I ever have a need for an asset-based finance advisor, I'm going to be interested in talking to Crown.
And if you're an entrepreneur, to be able to have access to potentially 140 or so situations, that feels, it would put me at ease if you're not getting pigeonholed. There could be situations where you really can only provide one or two potential scenarios for success, but at least you knew, at least as the entrepreneur would know that you took it to market, so to say, that you really turned over stones that they couldn't find themselves. And there's no substitution for that kind of depth.
Right.
Yeah. When we're taking something on, you like to know that there's going to be a few places that will be where the transaction will resonate. And also, a big part of our value proposition is not wasting people's time. So we're clarifying that pretty early in a process. I hope that lenders respect that, and I think that they would say this, because it's very important to us when we're taking a transaction to market. Yes, we obviously owe it to our client to create competition and make sure there's alternatives, because any one lender can not like a deal for any reason. But we're at the same time not spinning wheels. If a transaction is not bankable, we're not going to 30 banks just to show our client how great we are at going to 40 different lenders. We're flushing that out early. And vice versa. We're to the extent that there's a transaction on the margin where there may be, it may go bank, it may go FinCo, we try to communicate that up front. One important note is we do not bluff at Crown. We do not bluff to lenders, and we tell clients we do not bluff. And so we're very transparent. And sometimes we're surprised that lenders don't ask us for more feedback, because we'll just provide what we can say, which is, hey, here's why we think this could be a fit for you. We could be wrong, but here's how we're thinking about it. And if it's a FinCo who asks us, hey, are you taking this to banks? We would say, if we are, we would say, yeah, we are, but we don't know where it's going to end up. And we also don't understand, our client has given us the following objectives for this transaction. So here's why we think this is a good look for you. And that's all part of our value proposition of being efficient, effective, not wasting other people's time, and certainly not wasting our own time.
Yeah. I think that's so beneficial, kind of tying it back to what you had said earlier, is understanding the lender's underwriting, their criteria, their needs, and then also understanding your client, being able to fit the two together for, what seems like what would be best for the client that meets their timeline and their needs. It goes without saying how important that is, and how appreciative I'm sure your clients take that, which is a big reason why they turn to you. They don't have the knowledge that you do, the experience, to make this process seamless. Before we wrap up, I kind of wanted to get your thoughts. Is there anything in the future that you're looking forward to that excites you, that you kind of have on your radar?
So I'll assume you're asking limited to the ABL industry as opposed to excitement overall in life.
Either one.
A lot of things in life,
Yeah,
but I think
yeah,
he wants
either
ABL
one.
industry, but
There's a lot of things I'm really excited for, specifically with it relating to our industry. Naturally, we're a startup investment bank. We feel like we're in the inning 1 or 0 in Crown's evolution, so that's a very exciting place to be. But for our industry, this time 10 years ago, ABL had a kind of a overall market reputation as being a bit of a loan of last resort, or not an area where that would be relevant to middle market companies that have options. I think that we've all seen the product become much more mainstream and have a lot more interest from the overall debt capital markets. So I'm excited about that. I'm excited to be in an industry where there is tailwinds and growth and interest. I really enjoy being in a niche that's complicated. It's a lot more fun to try to build Crown where we believe we have actual specialized edge in knowledge, as opposed to, for instance, trying to compete in cash flow lending, where there's a lot of wonderful firms that have been doing so for 150 years, and we probably could do a good job if we tried, but don't have any edge. So I like the fact that our industry is growing and dynamic, and I also, generally speaking, think that my own view on what will create more robust opportunities is when the M&A markets come back. And, M&A volumes have been significantly down for 23 and will continue to be for 24. And there's also been a lot of opportunity during that period of time. But I think to the extent that the capital markets in general pick up, I'm not an economist, but at some point there will be mean reversion. And when that happens, there will be rising tide for the market and just more deal activity. And, it'll be an exciting time whether that happens or not. But certainly while there's increasing activity, I think there should be even more momentum. And that's exciting to think about over the next couple of years.
We're definitely excited to watch you guys grow alongside the industry. I think what you guys have been doing is great. Once again, thank you so much for joining us. It was awesome talking shop, getting your perspective on these topics, sharing your knowledge with Vince and I and our viewers and listeners. So, Mark, thank you so much. Vince, thank you so much for joining me. Mark, where can our viewers and listeners find you?
Well, digitally, Crown. First of all, we have our information on our website, crownlp.com. People can download our V cards. Hopefully this interview goes viral and I'm just fully inundated with responses. But also, on LinkedIn and physically offices in Palm Beach, Florida. So if anyone finds themselves, usually we get more visitors between November and March than we do in June through September. So always welcome visitors.
All right. Well, thank you so much.
Thanks, Mark.
Yeah, it was great talking to you. And to our viewers and listeners, thank you once again for joining us on another episode of In Focus with Haversine Funding. Remember to stay informed, stay inspired, and stay on course to growing your financial platform. Till next time.